Welcome back to the Wall Street Podcast. We've got a really timely and important deep dive for you today.
We certainly do.
We are unpacking a comprehensive first take on Alphabet Inc., GOGL's Q2 2025 earnings report.
That's right. This analysis comes straight from a first take report published by Goldman Sachs & Co. LLC. They got it out fast, July 23rd, 2025, just after 4:04 a.m. Eastern, right on the heels of the earnings announcement.
Exactly. And our mission today is pretty straightforward. Distill Goldman Sachs' initial analysis for you. We want to cut through the noise, cover the key financials, the strategic insights that actually matter, and their take on the expected market reaction.
Basically give you a rapid but thorough understanding of Alphabet's performance and where they might be heading, the critical nuggets you need.
All right, let's dive in. Starting with the market's immediate pulse. Goldman Sachs anticipates, perhaps surprisingly, a muted short-term market reaction to these Q2 earnings.
That's their initial call.
Which, seems a bit counterintuitive given the numbers we're about to discuss look pretty strong.
Yeah.
Why would Goldman Sachs predict such a sort of restrained initial response? What's potentially capping the stock here?
Yeah, it's a good question. It looks like a bit of a classic buy the rumor, sell the news dynamic might be at play here. The stock had a pretty significant run-up before this report dropped.
Oh, okay.
So that suggests a lot of the positive news, the strong performance, might have already been priced in by the market. But honestly, the bigger factor they flag is the uncertainty around the impending search antitrust remedy decision.
Right, the regulatory overhang.
Exactly. That's a major hurdle looming, potentially bringing new operational constraints. Even with stellar financials, having a major legal decision pending that could reshape your core business, well, that kind of uncertainty can definitely put a damper on things in the immediate term.
Makes sense. So despite that short-term caution, the report does maintain a constructive long-term view for Alphabet shares. What's bolstering that more optimistic long-term outlook then?
Well, that positive long-term view is really anchored in the broad-based strength they showed across their revenue streams. We saw better than expected results in all four main segments: search and other, YouTube ads, cloud, and subscriptions.
So strength across the board, really.
Pretty much. And that isn't just a blip. It underscores Alphabet's huge exposure to the whole digital economy. Plus, the potential positive impacts from this massive shift towards AI, which touches pretty much everything they do.
Got it. And I noticed the report consistently highlights the incremental margins and the overall rising margin trend in Google Cloud specifically.
Yeah.
That feels significant operationally.
Absolutely. That's a key point they stressed. Okay, so let's get into the actual hard numbers for Q2 2025. Alphabet reported consolidated gross revenues of $96.43 billion.
And how did that stack up against expectations?
It didn't just meet them, it significantly beat them. Goldman's own estimate was $93.91 billion, and the FactSet Street consensus was right there at $93.90 billion, so a solid beat. And that represents a healthy 14% year-over-year increase. Strong top-line growth.
Okay, can you break down those revenues by segment for us?
Sure. So Google Search and Other, that's the core, came in at $54.19 billion, up a solid 12% year over year. YouTube ads continued its strong run, hitting $9.80 billion, up 13% year over year. Network advertising, which is their ad business outside their own sites, was $7.35 billion. That was actually down slightly, about 1% year over year.
Okay, a small dip there.
Yeah, but the real standout, as we mentioned, was Google Cloud. It reached $13.62 billion. That's a jump of 32% year over year. Really significant growth.
Wow, 32%. That's huge.
It is. Then you have Google Other Think hardware, Play Store revenues that came in at $11.2 billion, up 20%. And finally, other bets, their moonshot projects like Waymo, Verily contributed $373 million, up a modest 2% year over year.
Okay, so cloud really powering a lot of that growth. What about profitability?
Profitability looks strong too. Q2 GAAP operating income hit $31.27 billion. Again, that surpassed both Goldman's estimate of $30.59 billion and the Street's $30.89 billion.
And the margin.
That resulted in a strong 32% GAAP operating income margin, which is, a key indicator of core business health.
Right. And segment operating income.
Looking at the segments, Google Services, which includes Search and YouTube, reported a very robust $33.06 billion in operating income.
Okay.
Google Cloud, importantly, turned in $2.83 billion in operating income. That really validates its improving profitability profile we talked about earlier.
Good to see cloud contributing positively there.
Definitely. And As you'd expect for these long-term ventures, other bets reported an operating loss of about $1.25 billion.
Understood. And the bottom line, the EPS.
Q2 GAAP EPS came in at $2.31. That comfortably beat Goldman's estimate of $2.12 and the street's $2.17. So yeah, strong performance pretty much across the board financially.
Okay, impressive numbers. Now, the next big question for investors is always, where's the money going? Alphabet has significantly increased its 2025 capital expenditure forecast. It was up to $75 billion. Now it's projected at approximately $85 billion. That's a huge $10 billion increase.
It is a massive jump, and it signals, really, a profound commitment from the company to invest well beyond just keeping pace with the current AI shift. They're essentially doubling down on their future infrastructure.
A big bet on AI and cloud, then.
A massive bet. It's positioning them for growth for years to come. However, Goldman does note that this substantial increase, well, it might require some digestion from investors. People will want more clarity, more visibility into the margin and EPS growth trajectory for 2026 and 2027 now.
Right, asking when that investment pays off.
Exactly. It's a strategic gamble, a necessary one perhaps for long-term dominance, but it does raise near-term questions about margins.
Okay. The report also flags several key focus areas for the upcoming earnings, called things investors should really listen for. What are those?
Yeah, Goldman highlighted a few key things. First, broader digital advertising trends, demand by industry vertical, by geography. That gives you a sense of the overall digital ad market health. Second, any commentary from management on how the core search product is evolving, especially with AI integration, and their view on the competitive landscape there.
Critical point.
Definitely. Third, a wider view of YouTube's scale, both advertising and its growing subscription business. Fourth, the environment for Google Cloud looking at revenue, and importantly, backlog trends, which signal future business.
Okay.
And finally, and this ties into the capex point, any key messages on their cost base, specifically how they plan to balance efficiency drives with these huge growth investments and capital returns to shareholders. That balance is key, especially with that $85 billion capex number hanging out there.
Right. A lot to unpack on the call itself.
Yeah.
Now, let's circle back and dig a bit deeper into a couple of these points. You mentioned Goldman expects a muted short-term reaction despite these really strong Q2 financials.
Yeah.
You explained the run-up and the antitrust overhang. But given just how solid these numbers are, beating revenue, beating EPS, cloud growth accelerating, isn't there still a strong case that these results should ignite a more significant immediate pop? What's the counterargument to that, maybe digging deeper into the antitrust issue?
It's a fair challenge, and it really speaks to how markets weigh different factors.
Right.
While the financials are, objectively strong, exceeding estimates across the board, the market's reaction is constrained, as Goldman sees it. Yes, the pre-earnings run-up is part of it, reduced surprise factor.
Yep.
But the core issue, that antitrust decision, it's not just some distant legal cloud. It's perceived as a direct, potentially material threat to Google's core search operations.
How so, specifically?
Well, potential remedies could impact how they integrate their own services into search results, how results are displayed, maybe even aspects of their advertising model tied to search. When your primary profit engine faces that kind of potential mandated change, even if the probability or severity is unknown, it creates a significant overhang. Investors are essentially weighing today's great numbers against tomorrow's potentially altered playing field. That uncertainty can really trump strong current performance in the short term.
That clarifies the weight of that uncertainty. Okay, let's pivot back to Google Cloud. That 32% growth, the improving margins, it feels strategically crucial. Can you elaborate on the strategic importance of cloud's performance and how directly it connects to that increased capital expenditure?
Absolutely. Google Cloud's performance isn't just a nice-to-have. It's strategically vital for Alphabet's future narrative. It demonstrates they have another powerful growth engine beyond advertising.
Diversification.
Exactly. And the fact that it's delivering incremental margins, meaning profit grows faster than revenue at the margin, signals it's really hitting scale and becoming a more efficient, mature business unit. This directly justifies, or at least underpins, that massive $85 billion capex decision.
So the investment follows the success.
In a way, yes, it shows confidence. The spending isn't just for keeping the lights on or incremental AI improvements. It reflects a deep strategic focus on building out the foundational infrastructure needed for long-term leadership in both cloud and AI. It's about securing their place in that high-stakes technological arms race for the next decade.
An arms race, that's a good way to frame it.
It is. And while this proactive investment positions them very strongly for future growth, it does, understandably, make investors ask about near-term margin dilution before those investments fully mature and yield returns. It's definitely a long-term strategic bet requiring market patience.
A long game indeed. This brings up a crucial question for our listeners.
Yeah.
Looking beyond these immediate dynamics and strategic plays, what does Goldman Sachs see as the primary long-term drivers for Alphabet? But also, what are the key risks they've identified?
Right, the bigger picture. The long-term constructive view from Goldman is mainly driven by Alphabet's just unparalleled broad exposure to the entire digital economy. They benefit almost automatically as more activity moves online.
Hmm.
And layered on top of that is the significant potential boost from integrating AI across all their segments, search, cloud, YouTube, everything. That's seen as a major future growth catalyst.
Okay, those are the drivers. What about the risks Goldman flags for their buy rating?
They outline several key risks to keep an eye on. First, just intense competition for users' attention, for product utility, and obviously for advertising dollars. It's a tough market. Second, potential headwinds specifically for monetizable search, maybe from new AI interfaces disrupting traditional search patterns, or just shifts in how people find information. Third, changing media consumption habits, possibly impacting ad revenue on platforms like YouTube.
Right.
Fourth, the risk we discussed. These very heavy investments, particularly in AI and cloud, could potentially depress operating margins for longer than the market expects, hitting near-term profitability. They also mention the possibility of lower than expected incremental shareholder returns in the near term, even if the company grows.
Meaning buybacks or dividends might not keep pace.
Potentially, yes, if investment takes priority. And finally, the ever-present regulatory scrutiny and potential industry practice changes, like that search antitrust decision, that could fundamentally alter their business model or prospects. So, a strong base, but definite risks to monitor.
A clear-eyed view. So pulling it together, Goldman Sachs maintains a buy rating on Alphabet. What's their specific price target, and how do they land on that number?
They're holding their 12-month price target at $225 per share. Based on the closing price referenced in the report, $191.34 on July 22nd, that suggests a potential upside of around 17.6%.
Okay, and the methodology behind that target.
It's based on an equal blend of two standard valuation approaches. First, they use an EV to GAAP EBITDA multiple, looking out about a year, that basically compares the company's enterprise value to its core operational earnings power.
Right.
Second, they use a modified discounted cash flow, or DCF, analysis. This projects future free cash flow, but importantly, they adjust it for stock-based compensation to get a clearer view of cash flow available to shareholders, looking out about 4 years. So it's a mix of near-term operational value and longer-term cash generation potential.
Got it. A blended approach. So this deep dive into Goldman Sachs' first take on Alphabet's Q2 really paints a picture of a company firing on most cylinders financially,
Definitely strong numbers.
while making these huge strategic bets on AI and cloud for the future.
That's right. The report really balances those immediate market factors like the antitrust uncertainty we discussed with a pretty strong conviction about the long-term outlook anchored in that broad digital exposure and the massive AI potential.
Which leads to a final thought, perhaps for our listeners to consider. What are the broader implications of Alphabet's escalating investments in AI and cloud? How might this reshape the competitive landscape in the tech sector over the next few years, maybe changing the game for everyone involved?
That's the billion or maybe trillion-dollar question, isn't it? These massive investments by Alphabet and others like them are fundamentally raising the stakes. It's creating an intense innovation race, but also an infrastructure arms race where sheer scale and capital become critical competitive advantages.
Making it harder for smaller players.
It certainly could. It might drive smaller companies towards niche specializations or force consolidation through partnerships or acquisitions. We could see a clear divide emerge between the few giants building the foundational AI and cloud platforms and the many companies building applications on those platforms. Alphabet is clearly signaling they intend to be one of the primary architects of that foundation. It's a game of scale, foresight, and massive capital allocation.
A fascinating dynamic to watch unfold. Thank you for joining us for this deep dive.